Welcome everyone to another Maine SBDC webinar. My name is Kelsey Reardon and I am with the USM State Office team. And we are joined for the first of a four-part series with Maine SBDC, now at CEI Business Advisor Rainer Large. So we are excited to have him on the CEI team. Sad to see him leave the AvCog team. However, we're thrilled to keep him within our ranks. And if you have worked with him before, you know that he is perfect for running the session because he's one of those people that gets like kind of disgustingly giddy talking about numbers, which if you're in this series is probably not how you feel about numbers. And so it's really great to have someone like him present it all in a manageable, understandable way. So we are going over financial projections, and it is a four-part series. So we're meeting the next three after today, Tuesdays from 2 to 3 p.m. And there is actually an additional event on December 2nd, which is projecting revenues. And that's going to be like a separate event, but will tie into this. So if you want to join that one, all of that information will be in the emails that you you'll receive from me after each session. I'll send out a follow-up email that will include the slides and a link to the recording. So just a heads up, we are recording these sessions so that if you can't make one, you can always watch it after the fact. We host all of our videos on YouTube, and these videos will be published on there, but as unlisted. So they won't be public facing, like anyone who comes to the YouTube channel would see it. However, if you have a link to access it, you'll be able to go back and watch it again. So because we're talking about numbers and financials, we want to make sure that we're protecting your information as much as possible. But just so you know, these are being recorded. And all of that information will be in those follow-up emails from me. Any additional information that gets mentioned, any links or anything, will all come hopefully same day, later that afternoon, but it might be the day after a couple times. We will be using the chat feature to network, talk to each other, and also submit any questions you have along the way. We are kind of a smallish working group, so we'll be able to unmute ourselves and talk to one another, but feel free to introduce yourself in the chat and just stick any questions you have along the way. We'll stop and answer any of those, and there'll always be time at the end for additional questions. Like I said, my name is Kelsey. You will get many emails from me. If you ever have any questions, you can respond to any email that you have gotten from me, and it will end up in the same place. So feel free to reach out in between sessions. And otherwise, I will pass it over to Rainer.
Great, thanks, Kelsey. Yeah, just, we kept this intentionally small, and I did that on purpose because I really do want this to be kind of a roundtable discussion, a little more engaging, and understanding that the goal of this is pretty in-depth, and it's a topic that not a lot of business owners are very comfortable with. So I really do want that engagement aspect of this to be open-ended. So if you don't want to drop your question in the chat and you'd rather just jump in and ask it, please do so. That's a little harder to do if we have 20 or 30 people, but like I said, we made this intentionally small for that purpose. So if you have a question, I'm sure somebody else has the same question. Like I said, the goal for this is really that by the end of it, I want you to have the next 12 months of your business projected out through the end of 2022. I want that broken out by month, and the goal is to really use your financials, your historical information to build that out so you have a real actionable plan and model that you can use to look forward and make changes to as you see necessary. So today we're going to talk primarily about kind of theory, basics, lay the groundwork, talk about the different financial statements, why they're important, why they're designed the way they are. So give a little bit more of that why background. Next class, we're going to dive into your QuickBooks. So we'll walk through exactly how to pull reports, what information we're going to be looking at, why that information is important, and then how to pull it into Excel and kind of format that in a way that we can use in classes 3 and 4. Class 3 is going to be predominantly talking about identifying historical trends, understanding how to build the model projected forward. We'll talk a lot about the logic behind that, what you're looking for, and what we can use to make that prediction. And then the 4th class is really a little more theoretical, right? So a lot of the information we're going to use to project is based on historic performance. It's kind of the idea of your momentum is going to carry you the same direction that it's been carrying you. And then the 4th class, we're going to say, what if? The question of, if we make these changes with the intended impact, how does that look to our cash flow? So again, by the end of it, I really want to give you both the tool itself, that financial model, as well as the understanding it takes to look forward for those next 12 months from January through December of the next year and say, okay, is this the direction I want to be traveling in? And if it's not necessarily the direction I want to be traveling in, where do I need to focus my time, my energy, and my money to change that outcome so that by the end of next year, you're that much closer to your goals, whatever it is. So why bother, right? That's a question I get a lot, right? I can pay a bookkeeper and they'll do this for me. Isn't that enough, right? So there's really 3 things that I want to focus on that I think that I find my passion, right? That I really get excited about this. The first is external, okay? So the language of financials is really the language of other professionals. If you've gotten to a point where your business is successful or it's break even and you're making ends meet, that's great. You've done something very well to get to that point. Your operational understanding, why you've gotten into the business, has gotten you to where you are. But conferring that intuitive knowledge that you've gained over the years and communicating that with other professionals can be difficult, right? If it's just intuition, how do you communicate that? And the financial model is something that other professionals use. So if you want to talk to your accountant and figure out a way to mitigate some of your tax burden, right, you need to be able to understand that financial model. If you want to talk to a business broker or an attorney about possibly selling your business or transferring your business to your children, understanding that financial model becomes critical. Understanding what you've done to create a viable business and communicate that in that financial model is that language that broker understands, the attorney understands, the accountant understands. If you want to go to a bank and get a loan, again, being able to convert your knowledge into that financial model, where your sales come from, what your expenses are, that cost of goods, all of that is that natural language of the business, right? And saying, okay, the way I'm using my assets generates revenue, and I can use that revenue to buy new assets, to pay down liabilities, to pay out to equity as an owner. Those are the 3 things that we can use that net income for. So the first way that this is so important is with that external communication. Yes, you can run it internally. Yes, you can do a great job doing that. But if you need to communicate with those other professionals, plan for that next step, you need that basic knowledge. The second reason that the financials become very important is internal, right? So if any business decision you make has the intended outcome of that decision and a cost associated with it. Everything that you do in a business, you make thousands of decisions a year, buying new real estate versus continuing to lease, adding another product or service line, doing online sales versus in-store sales, right? All of those decisions are somewhat apples to oranges. And the financial model allows you to boil it down and just say, okay, what is the best financial decision for my business? What is the cost of both of these decisions? What is the intended outcome of both of these decisions? What is the likelihood that those things happen? And what is the best decision that I can make to strengthen my bottom line, right? So again, manufacturing, buying new equipment versus hiring additional labor, increasing your wages versus adding a bonus structure. All of these different decisions that you make day in and day out, how do you compare them? You have to be able to understand the best one that strengthens your bottom line. Now, the most common objection I get to that is that you're not in the business just to make money. And I definitely respect that. And I don't want to say that you're not, right? There's so much more to running a business that makes you stay up at night, makes you lose sleep, that makes you do what you continue to do, and make that decision day in and day out rather than going and working for someone else, right? And that motivation comes from so much more than just the bottom line. And so, I understand that. And I've seen many, many business owners succeed without any understanding of the financials whatsoever. $10 million companies where the owner could not tell me the difference between an income statement and a balance sheet, right? That's fine. I don't want to say that you can't do it without that financial knowledge, but every single business that I have helped through bankruptcy, through a turnaround, through liquidation, the owner has not understood these things, the basic understanding of financial statements and how they work together, right? So I don't want to say it's a ceiling, that's a limitation. It's not. It's a floor. The financial understanding allows you to do everything else that motivates you. And I think that's really important because I don't want to lose sight of that motivation, whatever it is that drives you to do what you do, but allowing you to look forward and make the best decisions that empowers you to do that is where the financials really come into play. We'll talk about it a few times and throughout this course, how you can use these projections effectively. And they're not day-to-day things. They're not going to take hours out of your schedule to do, right? You're not in business because you like playing in Excel. Never talked to a business owner who got really good at Excel and wanted to practice, so they opened a business, right? You're in it because you like the people, you like the product, you like the service, you like doing what you do. What I want you to use this financial model for is to confirm that you're moving in the direction you want to move, right? And that takes 10 minutes a month if you do it right? So we're going to put these projections together, and then I'll show you how to put it back into QuickBooks so you can look at it and say, okay, if this was my plan, and this is what I actually did, how close am I? And as long as you're close, great, move on, go back to doing what you like to do. If you're not close, if you're missing something, it's better to know now than when you bounce that first check. Because once you start making that issue and you go down there and you're using credit cards to finance debt and so on and so forth, it's almost too late, right? So this is a way that we can stop sitting in the passenger seat of your business looking backward and start looking forward. And that's why I get so passionate about this, because it's a real way to put you in the driver's seat of your business and let you move forward. So, what are the financial statements? And why are they broken down like this, right? So there are three financial statements. Most of our time is going to be spent on the first financial statement, right? So the income statement, profit and loss statement, is what is your business doing? It's your operating statement. That's the month in and month out, year in and year out performance of your business. It's basically asking, how well are you using your assets? The balance sheet, if the income statement is what is your business doing, the balance sheet is what is your business, right? Your assets, your liabilities, your equity, your personal equity. And then the cash flow statement combines those two and says, okay, what is your actual bank balance at the end of the month? So why divide it like that? It can be very confusing, and it doesn't really make sense intuitively. And so through the years, I've kind of identified two main reasons that it seems to be driving this separation between the three statements. The first is most important for you, right? So that income statement, what is your business doing, allows you to compare period to period your performance, your operating performance, which is the most critical aspect, right? It's saying how well are you using those assets to generate revenue for your business. Now, if you go out and you buy a large piece of capital in September and you show that on your operating statement, and you look at September versus August, and you're going to say, geez, I lost money in September, I must have done better in August. That might not be true, right? The purchase of that equipment might have just shown a loss. So your cash flow would show that loss. Your balance sheet would show, that you spent money to buy an asset. But by taking that out of the operating statement, we can now compare August and September and say, okay, did I actually do better in August than September? Or am I missing it because of that piece of capital? So that's the first reason that these things are separated out. The second, a little more obvious, a little more straightforward, is that the IRS makes you pay taxes on your income statement. How profitable you are with your assets is what the IRS charges you taxes on. So just from a very basic understanding of, okay, what do I need to pay taxes on? What are we planning for? How do I work that into my budget? We need to separate that out. Now, what you do with that income statement, how you use that and reinvest it in your business, that is usually after taxes, which I'll get to. But we're going to stick with the income statement and kind of breaking it down. So again, this is operations. This is the most important for your day-to-day performance. It's where we're going to spend all of our time projecting, is looking at this. This is a very basic income statement that I put together. This is my ice cream and hot dog stand. Now you have your sales, your cost of goods, and your overhead. Those are the three parts of your income statement. Your sales are straightforward. It's over that period of time, I sold $12,500 in ice cream and $3,130 in hot dogs, right? So that's very straightforward. That is just what people paid you for your service, your product in that month. Now your cost of goods and your expenses are broken out into two separate things. Your cost of goods are the costs related to those sales. And I'll get to why it's important that we break this down. But for me, for my business, it's my ingredients and my direct labor. And the idea there is that if I want to compare that August and September performance, or compare through the year to next year, my cost of goods is going to go up and down depending on my revenue, right? If I have to go out and buy more ingredients and hire more labor, and I'm open from 8 a.m. until 8 p.m. rather than 2 p.m. till 8 p.m., and I have to hire more people, to get that comparison, that apples to apples comparison, we're going to look at my cost of goods as a percent of my revenue. The idea being, okay, if every dollar I sell, I need to spend 50 cents on ingredients and labor. And then I can compare, okay, in August, I spent 49 cents of every dollar I made. And in September, I spent 51 cents. So I spent a little bit more than I did. And then it doesn't matter what my revenue is. I'm accounting for that, right? So it ebbs and it flows with my sales. What doesn't change month to month, depending on my sales, is my overhead, right? Those are the things that are just going to be the same. My insurance, my rent, my utilities, my administrative payroll, right? Those things are just fixed. So, if I'm looking at my income statement, it's these three pieces. I'm saying, okay, I have all my sales, my revenue. Some of that's going to go out the door to my cost of goods, which leaves me my gross profit, this dark green piece. Then I have to back out my overhead. And what I'm left with is my net income, right? My net income is what I get to pay taxes on and then reinvest in my business. So, if I'm looking at this, your business has one goal, right? I want to maximize that little blue piece. I want to make as much money as possible that I get to keep at the end of the day. And there's really three things I can do to get there. There's a million things I can do, but it boils down to I can increase my sales, I can sell more product or sell more service, I can be more efficient, I can drive down my margin, my cost of goods margin, so I keep more of every dollar I sell, and I can control my overhead, right? So when we're looking forward, we're gonna look historically and say, okay, what are your cost of goods margins to date? What would that be in the next year? What is your overhead cost to date? What will that be the next year? And then we'll make those changes. We'll say, okay, what if we want to increase sales? Well, we have to spend more on advertising and marketing. That's our cost, right? So we go out and we say, okay, if we spend this much more in our advertising and marketing budget and we see a 10% increase in sales, what does that do to our bottom line? That's the whole point of projections, is to be able to say, okay, if I do this and I spend this much in this area, I spend more and add a second location in my lease, I go out and I buy that piece of equipment and have principal and interest payments, does it change my cost of goods margin? Right? Does that equipment make me more efficient? Do I add more revenue if I add another labor employee, right? So all of those things make that result. And then we can say, okay, how likely is it that I get the outcome I intend? How much money do I need in my bank account to instigate this change? So, okay, if I have to spend 5,000 and I only have 3,000 now, Whenever I have 5,000 in my bank account, which happens in March, I'm going to pull the trigger and do this, right? So that's why we use projections. We look forward and we can say, okay, this is my desired outcome. This is my intent. This is the cost. I'm going to wait until this point in time. Then I'm going to do it, right? Easy as that. And then I'm going to measure and make sure that that intended outcome is what I intended. So the balance sheet is what is your business, right? And the easiest way to kind of look at this is to think about a home mortgage, right? So if my asset is my house, say I have a $300,000 house, and I have a $120,000 mortgage on that house, that's my liability. Then my equity is the difference between those two, right? $180,000. And the idea there is very simple, right? The balance sheet is always balanced because the asset is always equal to some combination of liabilities and equity. Your business has some amount in an asset. It could be cash, it could be inventory, it could be equipment, furniture, building. You have your liabilities that you've created to get that asset, right? A mortgage, loans, small business loans, credit cards, accounts payable, and you have equity, which is the difference between those two. Hopefully your equity is positive. Now, how these two things work together is that net income, you know, this little blue piece at the bottom, whatever you're left with from your income statement, you can do three things with, right? You can go out and you can buy more assets. You can increase your asset base. You can go out and you can pay down your liabilities, decrease your liabilities, or you can pay it out to equity. Every owner's dream, right? You just keep what you kill. Whatever you have at the end of the day, you put in your pocket. Now, you know, if you're going to a bank and you're looking for a loan or you're looking to start up a company, you need to be able to show that that net income can support the liability, right? That's what a lender wants to know. They look at this and they say, okay, if you're going to borrow $1 million, are the monthly payments covered by your projected net income? If you're looking to sell your business, then, you know, a potential buyer is going to look at it and say, okay, I need to borrow this much money to purchase your business. I'm going to invest this much and I expect some return on that investment. Is there enough net income in that business to support that, right? So if your intent is to sell your business in 3 or 5 years, showing a larger net income is the best way to do that, to increase value. You're showing that your assets, that top piece of your balance sheet, the way you use those generates more money than it costs to renew those, right? So you're saying, hey, my policies, my procedures, the way I improve my product or have my service, I'm generating excess cash, right? That's what they're buying the ability of the business to generate future income. If you're looking at your income statement right now and you're saying, geez, I'm break even, then a potential buyer is going to say, well, there's no money left to support any debt, right? So there's no reason why I should pay more than the asset value for this. So, you know, if that's your plan, then we can work towards that. We talk about generating excess revenue, showing that in your tax returns, being able to demonstrate that. Then the third financial statement is the cash flow, right? In some ways, this is very redundant. This is basically saying, hey, here's the net income from your operations. You know, that's that top line. Here's how you're spending it, reinvesting it in your balance sheet, whether it's capital purchases, payments of principal on your liabilities, payments out to equity. But these bottom three lines are critical, right? So you have your starting cash, right, which is at the beginning of the month. You have your change in cash for that period of time. And then you have your ending cash, which is your bank balance at the end of the month. And that ending cash becomes your starting cash at the beginning of the next period, right? So that bottom line that I have kind of color coded there, that's your bank account projected forward for the next year. It's basically showing you, okay, what is the seasonality to my business? Where's the ebb and the flow of my cash? Does it ever dip below zero, right? Do I ever start bouncing checks? And do I end the year with more cash than I start with? So if I'm looking at this right now, I'm saying, well, this isn't great, right? I'm gonna end up losing about $5,000, $6,000 over the course of the year. Am I gonna bounce checks at any point? No, but I go from almost $17,000, or really $20,000 starting at the beginning of the year, to about $11,000. So I might have another year of continuing to have this operating statement in place before I start really running out of cash, but not much more than that, right? If I go from 20,000 to 11,000, maybe I can drag it on for another, 11 months, right? But the idea is the further we understand our cash flow and the further out we can look confidently with our projections, the more time we have to react. Right now, I'm giving myself 23 months to really say, okay, I need to increase my sales. I need to decrease my cost of goods margin, or I need to do a better job controlling my overhead, or I'm going to run out of cash, right? There's a finite number of ways I can change my operations, but eventually, with the current model, I will start bouncing checks. So if I know about that before I bounce checks, then I can start doing those things, implementing those changes. Any questions yet? Covered. So one other thing I want to talk about is when we pull reports, there's, and you've probably heard the term accrual accounting and cash accounting, and there's some confusion as to why what the distinction is. Most business owners, and I guarantee 95% of the people, attending this, use cash. Cash is very simple. It is exactly what it sounds like. It's cash. So if you perform a service, that service doesn't show up on your income statement until you get paid for that service, right? When the cash comes into your bank account. If you, if you have a vendor and that vendor gives you some inventory, you don't pay for that inventory for the next month, then that cost of goods cost doesn't show up on your income statement until you pay for it, until the cash leaves. So it's straightforward and it's simple. That's why a lot of people like to use it. It makes sense. It looks exactly what your bank account looks like. The cash method demonstrates it. Now, there's a problem with the timing aspect, which is where accrual comes in, right? So what accrual does is it says it doesn't matter when the cash comes in, it's when the service is performed or the debt is incurred, right? Accrual basically streamlines that process and allows it to be accounted for in the period that it takes place. So if you're a general contractor, for example, and you do $40,000 in service in 1 month and you don't get paid until the next month, and the next month you do $40,000 in service again, and you get paid for half of that in that month. And you're looking at your income statement. Cash would show no service done, $60,000 in service done, right? Because that's when the cash came in, was that second month. Accrual would show $40,000 in service done, $40,000 in service done. So accrual allows you to basically say, again, kind of that idea of apples to apples comparison. Am I doing better or worse? Accrual streamlines that. From an expense perspective, it's very similar, right? So insurance is very common. Insurance usually pay, call it every 6 months. Cash would basically say, no insurance, no insurance, no insurance, no insurance, 6 months of insurance paid, no insurance, no insurance, no insurance, no insurance, right? So it looks like if you're comparing apples to apples across those months, you do worse in 1 month, in one of the month, because that's where all the payment occurred. Accrual says, okay, 1/6 of that payment is allocated to every month, regardless of when it's actually paid. So it smooths that across it. You can change from cash to accrual. Good question. Pretty much at any time. It's just a method of entering the information and how you enter it. So I would talk to your bookkeeper or your accountant, and you can change that. Everybody pays taxes on a cash basis, right, which can be beneficial if you're working to mitigate some tax burden, right? You can pay for the next quarter's rent in 1 month if your accountant thinks that's a good idea, or you can pay for some marketing for the next year in the last quarter of this year, right? So it's when the cash leaves your bank account that you account for it. Now you're kicking the can down the road in that case, because then you don't have that expense fall into the next year. But from a tax perspective, that's kind of the theory behind it. But in terms of your internal tracking, it's just a matter of how you enter the information and what report you run. So when we talk about pulling the income statement, which we will we'll cover and dive into next class. It's just a button, actually. You can select cash or you can select accrual. And we'll select accrual because I want some of those things streamlined as they've been entered. So just wanted to kind of identify what those differences are. You'll hear those terms thrown around if you're hanging out in that professional circle with your accountant, your attorney, potential buyers. So, just educating you a little bit as to the difference. And then just to cover, so kind of our third class, we'll really dive into this part and talking about the projections, but we're going to look at 4 ways to project, right? So documented is very straightforward, right? Your lease is probably documented. You know exactly what that's going to be. Your insurance is documented, right? You have a bill for that you pay. So those things, we're going to be able to predict that plus or minus 1%, right? We know what that is. Historical, we're going to take 2 to 3 years of data and we're going to project forward based on that. So historical is saying, hey, if I spent $1,500 on office expense in 2018 and $1,400 in 2019 and $1,600 in 2020, I know plus or minus it's going to be about $1,500 in 2022, right? It's just looking back and saying, okay, what do I spend on average? And is that changing? So historic can be a straight line projection where we're just saying, hey, it's been more or less the same for the last couple of years, or it can be trending, right? If you spent $1,000 on insurance 3 years ago and $1,500 on insurance 2 years ago and $2,000 on insurance last year, okay, it's going up $500 every year. We'll probably spend about $2,500 unless we change it, right? Unless we go and shop that insurance. But that's the trajectory, right? And again, a lot of this is kind of momentum based. So we're saying, okay, a force at rest or in movement continues at rest or in movement until acted on by another force, right? One of the laws of, Newton's laws of physics. Unless we implement a change, unless we identify a problem, it's going to continue in that direction, up, down, straight, whatever it is. And that'll be most of our fourth classes saying, okay, what changes do we want to see to our financial statements? What actions are we going to take to change that momentum, up, down, straight, whatever it needs to be. And we'll identify action items, right? So you'll plan forward. You'll say, okay, here are the next 12 months, and here's what I need to do to get to where I want to go. Now, so that's, historical. That's looking historically. Obviously, the last year and a half has been somewhat tumultuous, right, with COVID. So we'll look at that too, right? If you're looking at it and you're saying, geez, everything was thrown off. How am I supposed to look historically? We'll take it case by case. Some things haven't changed. Some line items in your business have not changed, and some have changed dramatically. So we'll be able to identify those trend lines. And then we'll talk about, okay, is it better to use 2019 and 2018 data rather than 2020 and 2021? Are we returning to some semblance of normalcy? Or is the new normal upsetting the apple cart and we can't use 2018 and 2019 data at all because it's a whole different industry, right? So we'll be able to identify that. We'll deal with it case by case. The idea, again, being right now, if we look at 2022, right, there's a wide range of things that could occur. You could do really poorly, you could do really well. The more we use this logic to kind of narrow it down, are we ever going to get to a point where we know exactly what it's going to be? No. But when I did bankruptcy work and turnaround, we could usually get plus or minus 5%. That's kind of my goal, right? Is to let's narrow it down. Let's get it to a point where, yes, there's going to be hiccups. Yes, there's going to be things we don't expect. But if we can eliminate as much of the uncertainty as possible and really identify as much as we can what we know, then we'll be more confident moving forward. And so to complete that thought, it's usually a 3-month process. And I want to just put that in your mind, right? Because at the end of this, we're going to have 12 months. You're going to be like, this is awesome. Merry Christmas me, or whatever, seasonal holiday I celebrate. But at the end of January, you're going to look at it and you're say, I was off. This was not right. I wasn't 100% on this. what's the point, right? And I worry about that. And I will actually follow up in January with all of you to check in. It usually takes 2 to 3 times of closing the books and comparing to your actual performance before you get to that plus or minus 5%, right? Because there are things that come up. There are things that occur that you don't think about when you're putting these projections together. This is new information, right? These just the 3 financial statements. For many of you, you probably haven't even heard it broken down like that in a straightforward manner in less than an hour, right? So yes, you've heard these things. Yes, you've been, exposed to them, but it takes time to assimilate that information and turn that intuitive knowledge that you have as a business owner into that financial model. And so I would just encourage you, don't take it personally. If you get to the end of January and you look back and you say, I don't know what I'm talking about, this doesn't make any sense, I give up. Right? So stay with it. It gets easier as you do it, like anything. This is going to be the most overwhelmed that you will be just talking about this. I guarantee it, right? So we'll walk through these 4 classes. The 5th class is optional. We're just going to look at revenue for that one, how to project revenue. And you'll have some foundational knowledge, but again, it's kind of that idea of right now you don't know what you don't know. By the end of this class, you're going to know what you don't know, and that feels like a step backwards in a large extent. If you do this 2 or 3 months, then you get to that point where you can look at this in 5 minutes at the end of the month and you say, am I winning or am I losing? Am I doing better than I expected? Am I doing better than this time last year? If you can answer yes to both of those, that's great. Move on. Go back to doing what you're doing. If you can't say yes to one of those and you can identify why you're not meeting your budget, why you're not doing better than the previous year, then you have the information to change it before it becomes a real problem, right? That's the whole point of this, is to give you the information you need to make the best decision for your business. It's not to drive every decision you make. It's not to guide your hand and say it's all about making money, but it's to say, if your intent is whatever it is, are you on the right path to get there, right? This is a map. This is a financial model that looks from where you are to where you want to be 12 months from now, with benchmarks every month along the way. And if you are on that path, then you will get to where you want to be. If you are not on that path, if you don't know where you're going, then you will end up somewhere else. Could be good, could be bad. I'm not saying it's always going to be bad. You could end up great and not have any idea where you're going. A lot of business owners do that and it works out really well for them. This is just a way for you to make sure that you're going the direction you want to go. Sorry, I went down a bit of a rabbit hole there. So 4 types of projections we're going to use: documented, straightforward, very easy; contractual; historical, looking back in order to look forward, changing depending on what actions you're taking; relative, right, that cost of goods. We're going to look historically and we're going to say, okay, of every dollar you've made, what is related to that in expense? And if you're going to double your revenue, you're probably going to double that expense, right? So those things as a percent of revenue we use to project forward. And then when we change that revenue assumption, that cost will change accordingly. Payroll taxes is another one, right? If you're going to hire more labor, then your payroll taxes are going to go up. So again, these expenses are related to some other item. So we're going to identify that relationship and we're going to lock that relationship in so that if we change the primary assumption, that secondary expense will occur. And then zero-based, right? So zero-based is the idea of let's make it up and see what happens, right? It's that starting from scratch, that entrepreneur, that let's add a new revenue line, let's offer another service or another product. And we can substantiate that. And actually, I dive into this a little bit more in that that financial, the revenue projections class that we talk about, how to substantiate that, how to demonstrate that and make that a viable projection. But it's really the least reliable, right? Anytime you go to a bank and you say, this is my guess, right? They're going to ask for a lot more legwork on your part to demonstrate that that assumption is accurate. The rest of these documented historical relative assumptions, these are all demonstrable with historic performance. So that bank doesn't need that assumption to be proven out. You've already proved it out. This is what you've done, right? Or you're going to make this little tweak that will result in this. So again, that explanation of why are these projections accurate? How confident are we in them? It all has to do with these kind of logic rules, right? We're saying, okay, we either know it, it's a historical performance that we can expect reasonably to carry forward. It's connected to something else that we have one of those logic assumptions for, or we're making it up and we really need to spend a lot of time trying to justify that to ourselves, our investors, our employees, whoever we're talking to. And honestly, yourself is probably the top and most important person on that list. How do you justify that zero-based assumption? It's always case by case. But certainly invite you to reach out if you want to on those things. So some tips, afterthoughts. I love this stuff. I really do. It sounds silly, but for me as an advisor trying to help, at this point, I figured it out recently. I've seen more than 1,000 financial models with my various the hats I've worn through the years. I love it. Every single one tells a story, right? That's the idea of this, is we're saying, what is the story of your business? What will the story be? And for me to help you and come alongside you and support you as a business owner, it's the only way I know how to do so, right? To really plan a path forward rather than, reacting to historical performance, but to say, okay, where are we going? Year 1, year 3, year 5, and what benchmarks do we need to hit along the way? And you can tie that to, employee incentives. You can say, hey, if I want to be where we need to be a year from now, here's our sales every month. Let's break it down by week. And every week we know, here's the Post-it note on the, the break room. This is our goal. This is what we need to be doing. Not a year from now, not 6 months from now, but weekly. Right? We can break it down like that and give some real tangible benchmarks reflecting your seasonality, reflecting the type of business you're in, to understand that and work towards it and really understand, okay, day to day, am I doing what I need to do to be where I want to be, right? And it's so easy to get lost, and not see the forest through the trees, because there's 1,000 things that go on in your day as a business owner that are distracting and exhausting and take up your time and energy. But to know those 1 or 2 things that you really need to be focused on to achieve that long-term goal can help you substantiate it so much more than treading water, right? So one of the things we'll talk about is your industry benchmarks. We'll look at your cost of goods, your labor, inventory turns. Every industry is very specific. So again, we kept this group relatively small for that purpose, right? So if you don't know your inventory expectations, you don't know the kind of benchmarks in your industry, reach out. I'd love to kind of do that research with you, figure that out. And then when we pull that historic information, you have something to compare it to already. You can say, how do I compare to the industry? Where should I be focusing my energy? Geez, my cost of goods is 70% and my industry average is 60. Why is that? Am I, spending more? Do I have higher quality and I need to change my pricing? We can really delve into that and find some identifiable, tangible goals for you. If you have access to the information and you're comfortable with looking at your income statement, pull it up and take a look at it before next class, right? So we'll be pulling that information next class. We will be walking through it. But, look at it for the last couple months and identify, does it feel right? Right? As a business owner, you're living in it day to day. Does that information look and feel like you think it should, right? A lot of the time, it'll reflect it more or less. Intuitively, again, whether your business is doing well or doing poorly. If you're struggling to make payroll or you have more demand than you've ever had. So you know that intuitively, but go ahead and look at that chart of accounts, at that income statement and say, does this match my expectations? If not, why not, right? And we'll dig into that a little bit more. And then one other thing, don't fall behind on your QuickBooks entry, whether that's using a bookkeeper, using an accountant, having someone in-house do it. It's very easy to kind of put it aside, not reconcile your bank account, wait till the end of the year. But for these reports to be accurate, for you to have that information readily accessible, just keep on top of it. It's a lot easier than trying to do it retroactively. So I think I've covered everything that I intended to cover for the first day. I like to leave a little extra time at the end of it just for questions. Again, you know, a lot of our work as SBDC advisors is done one-on-one. That is my preferred method of communication and working with you. So please reach out. I'll put my email in the chat and make myself available. But we're here, you know, and if you don't know, sorry, can't type and talk at the same time. If you don't know your business advisor, I would reach out, you know, the main SBDC.org, and you can either request an advisor or find the advisor nearest to you. We're all cross-trained on this stuff. We're available. We're a free service. I don't know if we mentioned that at the top, but you know, we all prefer to meet one-on-one and work with you. And the reason it would be beneficial to know your local advisor is that a lot of us are just aware of kind of local opportunities. So yes, we service the state. Yes, especially during the pandemic, you know, these webinars and Zoom access is certainly universally applicable. But, you know, if you work in Ellsworth or Bangor or Portland, there may be some chamber activities, there may be some regional, you know, I don't want to say grants to give you the wrong opportunity, but local lending that might be advantageous to you to know about that I just wouldn't be aware of. So, you know, yes, I'm available to help you with this part, and I would love to walk through each and every one of your projections to double check and see how I can help and talk through specific issues. But it's worth knowing us above and beyond that as well. So, any questions? That's a great question, Kirsten. We've got someone in lodging. I know at least one marketing. I know convenience store. Who else we got? Great. This is great. So wide range, and that's all going to be really fun to build out and work with you. So we'll talk about seasonality and how to identify seasonality. I'm sure some of you are very seasonal, and others probably aren't. And I'll just stay on for another couple minutes. But otherwise, next Tuesday, like I said, be prepared to have your QuickBooks accounts accessible, be on whatever computer you want to be on to do that. We're going to actually go into your QuickBooks and pull statements into Excel, and I'll walk you through that. So then it'll get really fun, right? So I'll make it easy. All right, well, I'm not seeing any other questions, so I guess I'll go ahead and end this. I'll see you all next Tuesday, or reach out beforehand if you'd like.